Welcome to the Craftsman Founder Podcast, hosted by Lucas Carlson. Every week, we talk to founders, entrepreneurs, and those who've made a craft out of creating companies and enterprises. Listen every week to get ideas for starting, promoting, and growing your business. There are no shortcuts, just good old-fashioned hard work and craft. So sit back, relax, and enjoy this week's interview.
Hello, this is Lucas Carlson.
And Elliot Pepper.
And this week we have Josh Maher on the podcast, and I'm so thrilled to have him because he's just coming out with a book. By the time the podcast is live, you will be able to pick it up. It's called Startup Wealth: How the Best Angel Investors Make Money in Startups. And I think this is a really interesting book, not just for people that might want to be investors themselves, which this is a must-read for those kind of people. But also, I think it's a very fascinating book. I would have loved to have read it when I was starting a company myself, because there's not a lot of literature really explaining the mindset behind angel investors. At this point, there's a good amount of literature for understanding how venture capital works and the structures behind venture capital. But angel investors is a different kind of thing because it's much more personal. And what Josh has done is compiled interviews with 23 really top-tier angel investors, really digging into how they think and how they approach the art of investing. So for anybody who's ever thought about raising angel investment, I think this is a must-read as well. So Josh, thank you for coming on the podcast. And can you tell us a little bit about yourself and your background?
Yeah, thanks so much for having me on the podcast. Love what you guys are doing here. My background, I'm an angel investor out of Seattle. I've worked in and started a variety of startups and larger companies. No huge successes, so nothing fantastic to speak of and brag about. This great success I had, but enough success along the way to be able to angel invest. So I think that's a good thing. And I've just been a real kind of passionate supporter and interested person in the angel community as well as the startup community. So as soon as I kind of had the ability to get out there and start investing in some of these great companies around, I just started doing it. And I kept finding over and over again that there weren't a lot of easy to connect with mentors on the angel side. Like as you said, Lucas, there was a lot of great stuff on kind of how VCs work and kind of the mindset behind VCs and how they deal with the economics of their funds and how that affects raising capital. But on the angel side, there's really nothing. There's a lot of stuff on terms, but not really about, hey, here's some of the best people and here's how they think about allocating capital. Here's how they think about pulling together a portfolio. And so I just felt like there was this gap in the information out there, and so I wanted to go find it and pull it together and kind of add to the community.
Maybe that's actually a nice starting point. As I'm sure you'll share a little bit about that psychology and how angels think through their investment theses. But just to get the ball rolling, what is the single thing that you think entrepreneurs misunderstand or don't understand about how angel investors think about making investments?
Probably the biggest thing is that angel investors are more, a little more nuanced than even a micro VC. And that's one thing I interviewed a few folks who had small funds. For example, Chris DeVore, he's a local investor here in Seattle. He has a micro venture fund, and a few others as well who have micro venture funds. And the thing that they kept talking about, and this kind of highlights why it's so different for angels, is the thing they highlighted as being more valuable to an entrepreneur with a micro VC is that they were very predictable. Someone could read on the internet what they looked like, what kind of companies they invested in, how much they invested, what the process was. And when you go to a typical angel investor, you don't get that. You really don't have kind of cookie cutter angel investors across the board where everyone invests the same dollar amount and everyone invests in a similar way. They look for the same things in due diligence. They do they do background checks, or do they just check your references, or do they just get a good sense for who you are after meeting and working with you? So it's really different, and so sometimes it's harder for an entrepreneur to understand what kind of angel investor they've approached. It's easy to find angel investors, but then if you go approach an angel investor who's really excited about the next dating app, or a B2C app, and you have a B2B business, or you're in some other area, you're really already starting that conversation from a disconnected perspective. So really just discovering kind of what stage investors play at, what industries they play at, what dollar amounts they play at, what their follow-on strategies are. It's difficult, and so and even for angel investors, finding good mentors to learn from, it's kind of that same problem. Who is the right fit that you want to partner and work with for a long time? For 10 to 15 years, who's going to be that partner? And you're starting from a clean slate where you have almost no information about these people.
So if you were to kind of give somebody starting out who had never raised money before some of the basic of advice for how would you go approach an angel investor, and what are some of the right things to do and what are some of the wrong things to do? What would you say are like the top one or two things?
Yeah, so from the entrepreneur's perspective, finding that lead angel who is going to help you pull in other angels, who's going to help set the terms, who's really going to partner with you from a long-term perspective, that's really where the most energy should be placed. Finding that right partner, usually through your network. You've already built a group of advisors. You already have CEOs that you trust. You have maybe you have legal staff that you trust. You should. But so this network of people who you've already established to start growing your business, that's where you start looking for that lead angel investor, and you start kind of early, or earlier than you think you're going to need it, so that you can establish a longer-term relationship with them. But once you start going to the angel groups, and or any other kind of angel network, or you raise money online through AngelList or Our Crowd or Dream Fund or any of the other sites out there, they're really looking for you to already have that lead angel. They're looking to say, okay, well, I trust this person that you've already brought into the process. They have a good track record. I can see how they're going to add value, and let me see how I can add more value beyond that with maybe a smaller dollar amount or even the same dollar amount. They're still looking for kind of that social trust. So finding that first investor through your network is critical, and then following that up with kind of that second thing of a consistent approach and plan to going to the different angel investors who are stage and industry sector appropriate. It doesn't take nearly as long as it should. If you kind of follow that approach, a lot of angel investors get the random cold emails about some oil field in Qatar that they could invest in. So sometimes the filters that people put out there are there because they do get a lot of noise, and not from valid startups that they would ever have any interest in investing in. So starting with the network, and then spending time and diligence on finding the right people. If you do cold email an investor and it's the right kind of opportunity, there's a pretty good probability that if they see the email, if they do read it, they'll at least open it and spend some time with it if it's the right the right opportunity for them. But 90% of the opportunities that investors get cold aren't the right opportunity. So it's trying to really fine tune who you're going to target as kind of those next investors.
And for somebody who has never found a lead investor and has talked to a bunch of them and found a bunch of angels that seemed interested, how do you get somebody to commit to be the lead?
So at that stage, at that early stage, the lead that you're looking for is someone who's going to be investing in really the vision of what you're trying to build. And there really ends up being kind of this breakdown of investors, and there are some investors who focus a lot on the metrics and the numbers. Those are generally not going to be the first investor in. because you haven't really established those yet. So you're looking for someone who is thinking in a visionary way about your company versus someone who's really excited about the high margins that your business might have. So when you start to go try to close a lead investor, if you started the relationship on the premise of this is going to be a high margin business, I'm going to get all this money back for you, you kind of started the conversation in the wrong way. You're starting the conversation from we're going to disrupt this industry, and here's this really cool stuff that we're building, and here's why we're the right team to just execute in this industry and in this space. And if that investor, is able to respond and add value to that part of the conversation, to focusing your vision and how do you really execute that vision in a meaningful way that customers appreciate, that's when you start to know that you've established the right connection and can move down the kind of the closing path. If you start the wrong connection, even if they're interested and they're engaged and they seem like a great person, when it kind of gets down to closing, it's a lot harder because they're still going to be asking for more information. They're still going to be kind of, wanting you to prove more, have more data points, prove more of the process, prove more of the thinking out. Whereas the visionary investor, they're really trying to jump on and invest in the vision. So that's the easiest way to, everyone closes a little different, but if you're approaching the wrong person, it's really tough to close.
So one thing you mentioned is that many micro VC funds and certainly standard VC funds have a much more formalized process that's also more transparent. It's easier to understand what their incentives might be, and there's more documentation of it out there in the world for entrepreneurs to find. You've interviewed dozens and dozens of angels researching this book. Can you give us a few tidbits, like a few examples of some of the different profiles of angels you talk to, how they think about angel investment and the kind of investment theses they would take to individual startups?
Yeah, absolutely. That's a good question. I would really try to push a lot on trying to figure out how people approach that. And some investors, they had they would organize their lives in a way where they would say, I'm going to write, X number of checks of this size every year, and so it might be $25,000 checks every year, and I'm just going to do that for the rest of my life for the foreseeable future. And I'm going to follow on the ones that are winning, and the ones that that aren't hitting huge milestones, I'm not going to follow on. So that's one profile, and I came across that a few times. Another profile of people are really they focus on mentoring at places like Techstars or any of the other accelerators around, and their approach was, I'm going to mentor at one of these accelerators, and I'm going to get to know entrepreneurs, and each class that comes through, maybe I invest in one and maybe I don't, but when I finally pick one, I'm going to invest a little bit, and I'll keep following on, and maybe I'm the only angel in the deal, or maybe it's just me and a couple of friends. But they're really focused on partnering deeply, spending a lot of operational time with companies, and helping them get to that next stage. So that's a different way to approach it, and they get a lot of, they really get to know the entrepreneur in a deep way. And then another way that people organize themselves is they allocate a percentage of their overall net worth, and they'll say, okay, well, I'm going to allocate 10% of my net worth, and I'm just going to write checks of whatever size, and I may or may not follow on. That's the other difference, is there's some that follow on and some that don't. And so they may run out of money in 1 year, they may run out of money in 6 years. It just depends on how many checks they write and how many great companies they think come across their doorstep. In my view, actually getting those investors can be somewhat more difficult, because it can look 1 year like they are incredibly active and will invest in everything that comes through their door, and the next year they're like, they're waiting for a return and they're not investing any money at all. And so as an entrepreneur, like, how would you even know? You have to go in the door, and they'll still want to meet you. They'll want to invest next year when they have money, but maybe not this year. So those are pretty much the main ones. The other nuance really is folks who follow on and folks who don't. Rob Wiltbank has a bunch of data. He's actually out of Portland or Willamette University, teaches there and teaches at the UW here. And he has a study that he's done twice now, and he's redoing the study for a third time. And in the last two studies, it was basically angel investing in groups. And groups of angels who invest and don't follow on have a good return on their money. Whereas if you look at the venture capital, and the return is about the same as whatever anyone else will quote you, around 27% IRR. But you look at a lot of other angel investors who don't follow his data. They kind of take the venture capital approach, which basically states that you have to follow on to get any kind of a return. And when you kind of look at the number that both of those two groups say their data proves, you should be able to get a return. The number's the same. Both of them kind of say around 27% IRR. So I'm not sure which one's accurate or if there's a lot of data correction, but that difference is helpful if you are trying to pick an investor who you expect to follow on, and if they just philosophically don't, because that's not the way that they're managing the economics of their personal funds, then they won't, and that can be difficult.
That makes a lot of sense. Can you tell us one or two of your favorite stories from your book?
Yeah, there's a lot of really good stories. So, I mean, to give you a sense, like the early investor in Google, Brad Feld's in there, he's a prolific natural foods investor, which almost no one knows.
He has like 40 plus natural food angel bets. It's crazy.
Right, yeah, it's amazing. I had no idea. I mean, we started talking about it, I was just blown away. I mean, it's like Justin's Nut Butter. I mean, there are all kinds of brands that everyone knows about, right? So those are really interesting.
Just to follow on that, I remember Brad wrote a piece on his natural food investments, because he almost never talks about it. So it's like really hard to find anything. But my favorite quote of his was that the reason why he likes betting on natural foods companies is because even if they go bankrupt, he can still help eat the inventory.
That's great. That's great. Yeah, that's so true. So those were interesting. I had two people I interviewed, and I included one in the book, and that was kind of I had this problem over and over again, that there were so many incredible stories, and I could only include so much. The book's too long already. I had to cut so much, but there was two gentlemen who invested more than 100% of their overall net worth into early stage companies, and that was something that was really fascinating. That people would, take debt on for their personal net worth, all investable income plus debt was invested in early stage companies for two people at one point in time. One person here in the Northwest and another person out in the Northeast. And that was really surprising to me. I didn't really expect that I would find anyone who had put that much more into it. And their kind of approaches and opinions were just kind of different and unique. The gentleman who's included in the book, Mike Krill, he kind of took a different approach to investing. He did a lot of work for equity with companies. So he would personally hire a salesperson to go help sell the product of the company he invested in, and he would go hire more salespeople if he needed to increase the sales. And so he would do those things to help his returns, but also in exchange for equity, kind of depending on the stage of the company and where they were at. So his approach was a little bit just different than a lot of other angel investors. He kind of really formed a group and a process around hiring people and investing a lot of money in these companies. So that was just a different approach that was really interesting. Another one that was really interesting was there's a thing in the angel community called the Halo Report. And the Halo Report, it's a valuable tool for both angels and entrepreneurs. It kind of tracks angel investing activity, and it's all self-reported data from angel investors directly. So there's maybe some things that are bad about it, but it's the best data that's out there. It's better than most of the data in like Mattermark or PitchBook or DataFox. for angel investments, who are people who are investing in angel groups, just because it's not public information. So the reason this report got created, or part of the reason, one of the reasons anyway, is that the founder of the report had invested in a company, an early stage medical device company, and the company had a wildly successful IPO. You guys have probably heard of it, Invisalign. You know, they make the braces, the clear braces. Huge IPO, and this guy made no money on it. He, was the first money in, or some of the first money in. Huge IPO, makes no money on it, and he's like, this is terrible. And the reason was, it's purely valuation. He invested at the wrong valuation. And so there's actually a couple more stories that he tells about this valuation problem that he personally experienced. And so coming out of that, he wanted to ask every other angel investor, well, what valuation are you investing at? And so now this report comes out, they're updated every quarter, and they have an annual deal that comes out with it, and it kind of lists what the valuations are around the country, what the average valuations are that angel investors are investing based on, to help both investors and entrepreneurs kind of get an understanding of where their deal fits in the grand scheme of things. And so I was surprised to kind of come across that story when I was going through the interviews.
Yeah, I think that's a very, very important one, because I think that a lot of entrepreneurs don't realize how much investors talk amongst themselves. Even if they don't read the Halo report, they certainly are talking with their fellow investors about valuations and the ranges, and those things can be so flexible. If you're seeing what's happening in the public stock market right now, things like that, if it continues much longer, it can have ripple effects that can really cripple startups from being able to raise money. And if you're an entrepreneur who isn't aware of those effects, it can be really scary to kind of expect to be able to raise money easily and then not be able to.
Yeah, absolutely. One of the people that I interviewed, he told some of these really interesting stories about companies he invested in the 2005 timeframe, and they went to go raise more money, in the 2008 timeframe, and they weren't able to, and they did. A couple of the companies failed during that process, simply because the public markets had depressed the interest of investors to invest more money in many things, public and private. And it was difficult to raise money. The capital was tight at the time, and those cycles happen, and you don't know, at this stage, if the company that you invested in or the company that you're building is going to be in need of capital during one of those times. It may not be in the 12 to 18 months, from now to your next raise, but it may be in the 12 to 18 months, for the raise after that. So it's hard to know.
Did you learn anything over the course of researching and writing the book that has changed how you make angel investments?
Yeah, the big thing for me really was this kind of concept of some investors are and I'm going to use actually a little bit of a public market nomenclature. So that there's some investors who are more momentum or trend-based investors, and I kind of talked about that a little bit, where they're more visionary. And the investors, they're not necessarily only seed stage investors, but they may be, the first money in, kind of well through the A round, who are really focusing and making a bet based on the fact that they believe a technology or an industry is being disrupted, and they're really excited about this team being the right team to figure out a way to disrupt that industry. And so they're, laser focused on those things. And then there's a whole other group of investors, who are, I would call them value investors, and I do in the book. So these value investors are, they're really focused on, okay, what, how much money can we really get out of this thing? What are the metrics? What's the margin? What does the month over month and year over year growth really look like? We know it's an interesting industry, maybe. Maybe they have some expertise, but they're more focused on the metrics and the value creation of the business, and less focused on we're changing the entire world. We're not going to use gasoline anymore. Those kinds of things. And you get this real divide of people, and they kind of disagree with each other with their approach to analyzing the entrepreneur, with their approach to analyzing the business, the market, how they source deals, the number of companies they look at. All of those things are just drastically different between these kind of trend or momentum focused investors and kind of these.
I think that you can even see that on the Shark Tank. I think Mark Cuban is kind of the ultimate trend investor and is always laughing at whenever anybody else says, oh, that valuation is too rich, and Mark Cuban starts laughing. He's like, oh, you'll see how much it'll grow. And some of the other investors are much more value focused.
Yeah. That's it's funny. I didn't really think about their behavior, but you're right. You're right. Absolutely.
And how do you think about angel investing?
Oh, yeah. So the way that came back to me was, I started thinking about, well, what kind of investors need to be involved in these businesses for them to be successful that I'm interested in, and so that was something that I didn't really think much about whether there was a visionary type investor or more of a metrics type investor, or if there was the right mix of those people, and so I've started. Since embarking on all this research and interviews, really kind of changing my, I guess the things that excite me about who else is invested in the company. I really like to see, someone who was with the company from a visionary perspective and is still passionate about the company. If the visionary investor is no longer, a believer in what's happening, that's a clear sign that, they made a bet with a lot of money based on, being really excited about it. So if they're not excited about it anymore, that's probably a problem. If there aren't people to help connect them to that next amount of capital, whether it's me or whether it's other people, that's also a problem. Saying, hey, the entrepreneur should be able to raise all the money that they need, and I'm never going to do anything to help them. As the previous investor, that's fine for some folks. But someone has to step up to help them in some way. So perhaps making sure that is someone is there to do that, and then also making sure someone is there who does actually care about the metrics, not necessarily from the first early first money in, but on the later rounds. When by the time you really get to an A round, you really need to be able to prove the metrics that you have and how you're growing them, and so having someone who can help them get to the stage in an A round where they can present those things to investors, or if I'm investing in the A round, that they do have those things and that those are, they understand how that part of the business works.
And are there any startups for whom you are the visionary first money in?
No.
Are you more of a value-based investor, or is that's just?
Yeah. Well. So I guess there are companies where I'm early, and there is another person who's more of the visionary investor who I'm a believer in as well. So there, I would say that I'm somewhat following some of those people and some of those businesses. I'm kind of in between, but much more on the value side. So there are. Most of the businesses that I'm invested in are where I'm earlier are they're B2B businesses and they're a SaaS business. It's somewhere where I have some expertise and I can kind of understand what they're going after and why that might be valuable, and so I can get excited about it. The businesses where I don't necessarily have as much expertise, then I'm either more of a value investor, or I'm following someone else into a deal.
Makes sense. And we asked you what entrepreneurs maybe don't understand about the angel investors they might be soliciting. But what are the biggest mistakes that you heard about angel investors making in their own bets?
Yeah, it's interesting. The one thing that almost every angel investor said or told me was that they have had a problem with other angel investors in a deal. And the kinds of problems were amazing. Actually, there was some pretty fantastic stories that I had to pull out. After I did all the interviews and kind of wrote these chapters, I kind of went back with everyone and said, "Hey, are you sure you want this to be published in the book?" And some of these investors were like, "Yeah, that's a really great story, but we need to pull that one out." And I mean, these were just stories about investors, really being, kind of mean to each other, and even in some cases, not very nice to the entrepreneurs. And the not very nice to entrepreneurs was mostly under the kind of the auspice of, hey, we're investing in thousands of companies, or we're looking at thousands of companies. We don't really care about that one. And so you see that maybe more on the venture side, and that story was the venture side one versus the angels. The angels not being nice to each other was mostly around not putting more money in, not being helpful, not being responsive. If paperwork needed to be signed, they should sign it in a timely fashion so the deal can close, that kind of stuff. And so there were just some of those things where when those things happened, many of the investors didn't want to reinvest with those people in the future. And so if you're an investor and you're just kind of negative, you add negativity to a deal, whether it's when you're first doing the deal or whether it's after you've already invested and something else is happening with the business. If you can't be clear and kind of honest and true to yourself and your actions, a lot of other investors will say, I'm not going to invest with that person again, and they'll note it, and they won't tell you necessarily, but they won't invest with you again. And I think that's the most damaging for a lot of people, and that's the thing that pretty much every angel investor said that they were worried about or had a problem with.
Makes a lot of sense.
This has been awesome. I know that you're a busy guy. I really, really appreciate you coming on. Where can people find your book?
Yeah, so the book is available kind of in all formats starting October 7th. So if you go to startupwealth.com, you'll find a link today to pre-order it, join the mailing list for more information, and actually I'm working on some last touches. I got approval to give away one of those interviews that I cut, and it's one of my favorite ones because the guy's a local investor. But if you pre-order the book or order the book before the end of October, and the rest of the details will be on the site, but you'll get this extra chapter with Jeff Entris. He apprenticed under Stan Druckenmiller in high school and college, and went on to do lots of venture capital and angel investing. So that'll be the free chapter if you order the book before the end of October. Startupwealth.com.
That's awesome. Startupwealth.com. You heard it here, so go get it. And thank you for coming on, Josh. It's been great talking to you.
Thank you, Lucas. Thank you, Elliot.
Thank you.
Thanks for listening to the Craftsman Founder Podcast with Lucas Carlson. If you like what you just heard, we hope you'll pass along our web address, craftsmanfounder.com, to your friends and colleagues. Be sure to check out our archive section on our website for previous podcasts. This has been a Craftsman Founder production. Join us next time for another edition of the Craftsman Founder Podcast.